Greg Branch, he's our headliner today, our halftime headliner, Veritas Financial. He's the founder and the managing partner. Welcome back. It's good to see you again.
Good to be here, Scott.
You have a somewhat of a smile on your face. That can't be because you've turned from Mr. Negative to Mr. Positive on the market, is it?
No. And so let me dimension this. Am I incrementally more positive than I was in January? Of course, Scott. In January, the S&P was at 4,700, and I was out on a limb saying that the true value was 3,800. But much of what I saw for this year is and has come to pass. And so, my discrepancy with consensus is not as great as it was back in January. Now, don't get me wrong. I still have very limited exposure to equities right now because I believe that we're facing a triple headwind. We're facing the headwind of the Fed continuing to raise rates. And as our colleagues have said, yes, they're targeting 4% for this year, but some are even looking at a terminal rate as high as 5%. Mm-hmm. And so there's still no real consensus on how far we're going to go there. 2, estimates still need to come down. There's no way the S&P is putting up a 60 in the back quarter of this year. That's probably 10% too high, as well as estimates for 2023, looking at 246, probably, again, 10 to 15% too high. And so as we're going down that downward revision cycle, that presents a headwind as well. I believe the consumer will be a headwind in this back quarter as well.
So what are you doing? Are you sitting in cash? Are you buying treasuries, which now offer a way to hide out finally, or more so a way to take advantage of the market in a way that you can't in stocks?
Right. I think Kevin hit it on the head. You got to go where the opportunities present themselves. And so that might be creeping back into fixed income to some degree. Earlier in the year, as you know, Scott, we were buying intermediate and long-term puts, and that strategy worked out well for us. Now that there's not as great a discrepancy between where I see at least the end of this year versus where the market is, that we've wound that down to a great extent. But I'm still looking for 2023 estimates to come down pretty significantly. So I'm just not a buyer here, ahead of probably another 2 basis points of rate increases, downward pressure on estimates that need to come in. Just can't advocate that right now.
Hey, Greg, it's Joe. Good to see you this afternoon. How much does positioning and sentiment play into where you think markets might go? Obviously, cash levels are at historically high levels. And it seems as though yourself, myself, universally, everyone seems to know the challenges and the headwinds that the market has. I see right now extreme pessimism being rebuilt once again, and I think that's being reflected in positioning. Do you think that ultimately matters, and can that be a tailwind for the market?
I think it matters, but I think our job is to separate sentiment from data and to go where the data leads us. And so we had a great deal of sentiment 2 months ago when we were all talking about a Fed pivot, and where the projection for this meeting was that they wouldn't raise rates at all. And so our job in that time, many of us did, was to say that this is a fake rally because it's built on the premise that Powell has given the green light to put on risk, that the Fed is pivoting, and that we've reached peak inflation. And all of that has, in fact, turned out to be wrong. And so sentiment has a tendency to be what we want and not what we see. And I think that that's our job, is to separate, as investors, be it professional or sitting home on your couch, separate what you want from what you see.
What if Powell is not going to be as hawkish as some think, that he recognizes the danger of a Gundlach word that he used with me last week of oversteering, that Powell knows as well as anybody that the cuts or the hikes that they've done already need time. They need time to work their way through the system. He also knows that a good part of inflation is, in fact, coming down. So maybe he's not going to be as hawkish as some think because of all of those reasons I just suggested.
I'll even add one more to your case, Scott, where they have massively accelerated QT as of September 15th, right? And we don't know the impact that that's going to have either. And so to some extent, you're right, he is driving blind a little bit as there is some lag effect. But we also know that a Fed funds rate of 2.5% or even 3% isn't significant enough to have a meaningful impact on the type of inflation we're seeing now. He also knows that as well. And so might there be some dovishness in terms of rate projections in the back end of this year or early next year, sure. But I think that September and November are all but locked in.
Well, there's also the unknown as to what, and he'll never say it, obviously, whether there would be some level of content with bringing inflation down above the target, that you don't have to go all the way down initially, try and get it to 2%. Of course, you want to get it to 2%, but maybe they're content with 4 or 5%. And that would perhaps be a big victory at this point. And it doesn't take that much for the market to read something as bullish, given everybody expects him to be hawkish. And that could therein be whatever, catalyst is sitting out there that could drive buyers back into the market and upset some of the more negative scenarios. We shall see, as I said. It really
depends on your definition of they. If they is us, yes, we'd be thrilled with 6 or 7%. If they is the U.S. consumer, you're talking about 5 and 6% on last year's 5 and 6%. And so they still wouldn't. That would still be an intolerable circumstance.
Well, I didn't say 6 or 7. I didn't say 6 or 7%. I didn't say 5 or 6% either. I said 4 or 5%. Now, obviously, I know the toll that inflation is taking on every person who lives. Obviously, right. I'm talking specifically about what the market would read in, because again, it will never be explicitly said. I don't think. Nonetheless, it's good to talk to you as always, Greg. We'll see you soon.
Thank you, Scott.
Yep, Greg Branch.